Now to help us focus on the fundamentals behind the technicals, we have Joseph Cavatoni, Chief Market Strategist of North America at the World Gold Council with us. Joe, good to have you here. Exactly what the bulls were looking for from Fed Chair Jerome Powell, and then some, one could argue.
I think you're right. I think over the last several weeks, probably about the month that we've had over the last couple of weeks here, you've seen the market wanting, expecting, anticipating, and actually actioning what we're
I like
starting to
that.
sense around the rate environment. It's basically um, we've been all eyes on the Fed, all eyes on monetary policy. We've been signaling it all year. We've got it in our outlook. We're going to continue to be focused on it because that's been the impediment for gold breaking out. I think you can see the demand, both speculative and we think and expect longer term buy and hold investors in gold are all waiting to see the clarity so that they can actually make that allocation back to gold. Again, speculation moving the price shorter term, and actually we're going to start to see things shift potentially for the longer term investor coming back to the market.
Is that why you see continued demand for gold? Because again, even per your notes here, it looks like historically a soft landing isn't necessarily very favorable, right? But you also point to how every cycle is different.
Every cycle is different, and actually nailing a soft landing isn't easy. And I think that what we're keeping an eye on are the factors that will go into all the different features of demand. And I think that it's important to understand that you have event risks
Mm-hmm.
that are still on the
Mm-hmm.
horizon. You've got systemic issues that are still out there, geopolitical tensions that are still developing. But in addition to that, you've got the likelihood of potentially the soft landing, but the development of a recession. And in the recessionary environments, the flocking to savings of hard assets, the flocking to the weak, or like I should say, flocking to the stronger the gold market would be where we would see investor dollars going. And I think that we're actually expecting a real clean soft landing to be something that would probably be a bit of a muted market for gold. But to be honest with you, it's a very difficult thing to land. And we expect that gold will have a number of other international or global factors that are going to continue to weigh in on why it will have a strong support over the course of 2024. As we see the rate cuts into 2024 as well, that's going to be a signal where people are going to continue to gravitate back. The central bank demand, by the way, year to date, and we're expecting to see these numbers coming through in the next couple of months, are really giving us an indication that that sense of demand is actually being a strong source for the price support for gold. And we have a lot of signals telling us that we're expecting to see that continue into 2024.
Joe, I want to talk about the central bank demand here a bit more. But first, let me just get back to the geopolitics for a second here, because I think it's important that we keep that front and center. I've been trying to remind our viewers, right, the headline susceptibility. If you're trading these products, crude, gold, for example, ultimately you're at risk. And I think it's important to remember and position yourself accordingly. But I'm curious, how much do you think, how much do you think, I guess is the question, gold percentage-wise, geopolitics added in terms of this rally we've seen? Because, well, the dollar was a big factor, but I keep tying, well, the recent spike we saw, for example, up into the all-time highs, oddly coincided with the resumption of the bombing in Gaza, right after the ceasefire that had taken place, not necessarily to the day, I don't think it was, but very close to. So there's obviously geopolitical tensions, uncertainty. To what extent here, what percentage do we see that play out this year, and to what extent do you expect it to be next year?
We think that about 3 to 4% of the
Okay.
performance of gold this year was attributed to what I would refer to as event risk, which includes the geopolitical issues that have developed over the last 24 months, to be honest with you, whether it's a Russia-Ukraine invasion or the circumstances that developed with Israel and Hamas in terms of the circumstances there. Those are geopolitical tensions. Those are issues that are actually pretty extreme. But don't forget, we also had a similar movement in the price of gold when retail investors and concerns around the banking sector hit us in March with the failure of 3 to 4 regional banks and Credit Suisse. So you saw again this flight to quality, this flight to safe haven, this flight to the safe harbor that gold provides you, and the price performance it can give you when the markets are moving in heavily volatile times. And that's why I think we've seen a good portion of the returns for gold this year come from event risks, including geopolitical risks. And when we think about event risks going into 2024, it's also geopolitical again, But you also have to consider the fact that high rates for longer may create cracks in credit and may create cracks in the corporate availability or corporate performance into 2024. So we're keeping an eye on the credit markets as well for the potential for event risks there. But in all of these scenarios, what we're asking for people to understand is that this is a diversifying asset that has that right kind of correlation behavior, that diversification behavior that gives you protection when things are volatile and maybe you're seeing price movements that are against what you're expecting.
Absolutely, which kind of adds to that demand aspect. To getting back to central bank demand, ultimately, it looks like, record year ultimately in terms of year to date, headed into the end of the year. But you expect, the World Gold Councils expect these trends that we've seen in terms of central bankers buying up gold to continue into next year as well.
I think that's right. I think what we're seeing is that it's really developing in emerging market central banks that continue to be the largest consumers of gold, including China. Year to date, we've got 800 tons through the third quarter. We've seen continued growth into October in terms of what's been reported so far. There's a bit of a lag, and we need to get validation on the numbers, but all things are signaling to us that we are headed towards, if not a record year, a substantially strong year. And again, the underlying factors that are driving central banks to buy, concerns around inflation, need for liquidity, that safe harbor asset that diversifies their portfolios, their dollar exposure, their concerns around geopolitical risks, and their concerns around potential impact to their portfolios if sanctions creep into other jurisdictions. Those are all still factors that are very heavily on the minds of all investors, but also central bank reserve portfolio managers. And that's actually going to give us a landscape for us to continue to expect to see these flows continue.
Yeah,
Now,
go
there could be a
ahead. Sorry.
change that we're not able to see, but at this juncture, I think we see a lot of factors still giving us an indication that diversification to gold is something that they'll continue.
Yeah, diversification all the way on down the line into some of the other factors you mentioned really speaks to, again, the complexities. Oftentimes we sort of tie that in more to crude oil, right? And some of the intricate kind of aspects of that equation that drive price. But speaking to that point here, a quick thought on the supply side of things, right? I mean, we've feel like covered the demand side of where that's all coming from. What are we seeing on the other side of the coin?
I think at this stage, we're going to see a continued slow and steady growth of supply, but we're not expecting anything dramatic to happen
Okay.
in terms of miners bringing gold to market. They're going to extract more out of existing mines, and they're going to extract more out of existing projects. And I think what we're going to expect to see a bit less of is probably that consolidation that we were looking at earlier in the year amongst the mining community. But at this stage, it's going to be a continued steady flow, and that mix between recycled as a source of demand or supply and pure mining is probably going to stay at that ratio. So probably about a 3 to 4% increase in mining production into 2024.
Okay, it gives us something to keep an eye on here. We're definitely going to watch gold as we head into the end of the year in relation to the dollar, as well as tying it into some of the fundamentals you've helped us cover here this morning. Joe, always a pleasure to have you on the show, and thanks for joining us here this morning as well. Joe, happy holidays to you and your family. That's Joe Cavatoni, Chief Market Strategist of North America for the North Americas at the World Gold Council.